The world has changed, and so has the way the world does business. Many companies look for ways to improve processes, manage costs, increase customer satisfaction, and generate added value. One approach is the migration to a shared service center model. As varied as the business driver for and users of the shared service center model may be, there is one common denominator that is too often missing from the strategic or planning elements of the shared service center decision. That is indirect tax. And although these tax considerations may not be among the issues that drive a shared service center decision, tax can certainly give rise to some significant and costly challenges. That is particularly true of value-added tax. For multinationals, these touchpoints can arise in a wide range of countries and taxing jurisdictions as well. As multinationals move to the shared service center model to meet their business objectives, the responsibility for indirect taxes migrates with them, especially in the case of VAT. It is important that you understand the business model, the absolute amount involved, the VAT complexity, and the impact of change. That means understanding the key numbers and thus the VAT numbers under management. These are impressive enough to get the proper attention of senior management. In this example, the VAT number, excluding the bad debts and realized savings that needs to be managed, exceed at least 3.6 billion euro. An error has a direct impact on EBITDA, which is an important business KPI. A mistake of 1% impacts shareholders' value. This simple table shows how important it is to manage VAT. Also, complexity in managing VAT increases when cross-border activities are involved, especially in today's VAT environment, where all too often processes are manual and procedures are not documented. Historically, the activities around transactions giving rise to indirect taxes have been handled by in-country entities that are more familiar with local regulations and compliance requirements, and accustomed to the local rules and obligations for invoicing, accounting, and reporting, specific to each of the jurisdictions. But what happens when VAT functions are transferred to an offshore shared service center in some far-away location? How complex will the operational requirements be when such a shared service center is dealing with countless transactions that originate in multiple countries and languages? Getting ahead of possible problems at the planning stage before they arise in practice is one critical way to make sure that the company realizes the benefits intended from a shared service center migration. VAT needs to move to the top of the priority list whether a new shared service center is being designed or an existing one evaluated. Since cost savings is one of the most common reasons for a shared service center, companies often go to what are considered low-wage countries, such as the Philippines, Hungary, Poland, or India. What is often missed in developing the business case and subsequent planning and execution is a full understanding of the processes and controls needed to effectively and efficiently manage indirect taxes. This knowledge gap can give rise to some important considerations. Inability to comply with local VAT rules. Although the root cause will vary from one company and country to another, the risk is likely to increase significantly because of the fundamental lack of resources with local VAT knowledge. Clear VAT policies and procedures, technology enablement, and controls to facilitate and monitor compliance. In most cases, there is some combination of these causes. System incompatibility. It is not uncommon to find that the EEP systems or other available technologies do not support shared service center staff as fully or effectively as required in making sound decisions related to VAT. Processes not clearly defined. Shared service centers sometimes find themselves operating without clear description or instructions as to how certain processes should function internally. That typically includes specific divisions of duties and defined responsibilities for every task and the person assigned to perform it, as well as the protocols for communicating with the tax office to receive updated information, escalate issues, and solicit valuable feedback. The more pieces missing, the greater the risk. Non-existent or inadequate processes and documentation. Since indirect tax guidance is not typically part of the shared service center brief, shared service center staff may not have access to VAT training, manuals, or web-based technology to support their decisions and activities related to VAT. Insufficient communication. Staff may also be hampered by inadequate or unorganized communication between the shared service center and other operational business units within the organization, making it very difficult to identify and address any crossover issues relating to VAT. Examples of such operational units are IT, logistics, or the group tax department. Non-existent or inadequate compliance controls. An indirect tax control framework and key performance matrix that focus on relevant indirect tax risks must be in place to provide the stability and transparency required to both enable and sustain compliance. VAT should be considered in every aspect of the migration process, from concept through completion and beyond. There are 3 steps: identify, diagnose, and design. These same steps can and should be applied from time to time to an existing shared service center to make sure that it is optimized and functioning as efficiently as possible and that it remains consistent with enterprise objectives in the event of changes in the business profile. Let's dive a little bit deeper on identify. VAT critical functions are among the most common transaction handling processes to migrate to a shared service center. That typically includes such functions as account payable, general accounting, intercompany settlements, travel and expenses, tax filing, customer billing, and order entry. This is essentially the time for defining the scope of the shared service center, documenting the current VAT processes for the various local business units, and determining what countries the shared service center will support and the processes for which it will be responsible. Underpinning these decisions should be a realistic perspective on the available technologies and talent pool. This early stage is the time for surfacing potential problems and identifying the time frame and approach for addressing them. For example, further integration of ERP systems, tax engines, procedural guidance and controls. The complexity of change that comes with implementing a shared service center and its various support systems give rise to some critical considerations. So the company must fully understand the degree of change that's about to occur and communicate and manage it across the enterprise. The diagnose step. The goal is to make sure that the outsourced VAT processes and functions are transferred and continue operating as effectively and efficiently as possible. That means determining whether the current processes operate satisfactorily, whether these need to be improved, factoring in any potential or existing differences and taking into account the complexity of the existing processes and the variations between these processes in each of the business units to be supported by the shared service center. One of the potential actions that may be taken is optimizing the VAT functionality of the ERP system. For example, some systems and tax engines include the option of using a condition table or decision tree to determine the appropriate VAT action without human involvement. Keep in mind that ERP implementation immediately prior to the shared service center go live is not realistic. System changes involve various stakeholders, are time consuming, and realistically take months to complete. So they should be considered as a medium to a long-term objective. As you begin to diagnose the current state and future state objectives of your shared service center plan, some questions that can help you determine the impact of VAT prior to migration. Do we have sufficient insight into current VAT processes, including all manual adjustments, workarounds, and internal quality assurances processes? Are the processes specific and well documented, and are they adequate to the new environment? Do we understand the scope of personnel changes that may occur as we migrate to the shared service center? Have we captured all the relevant knowledge from personnel who may decide to leave the organization? Are we retaining access to and information about existing manual processes and procedures and offline solutions? To what extent do current processes depend on local VAT expertise and technology? How much will be lost in the event of a transfer to a shared service center? To what extent are different processes required from one jurisdiction to another? Who has final responsibility for the VAT compliance process at present, and who will be owner upon transfer to the shared service center model? Where are the essential process controls being carried out? How does the shared service center model deal with local VAT risks in terms of internal communication and coordination? Let's talk about design. There are no standard solutions, just the central requirement that any solution be VAT compliant. What the future shared service center VAT interface will look like will depend largely upon the complexity of the transactions to be handled and the type of technology and talent pool available. If the shared service center design will be based upon the organization's existing ERP system, it's essential to know from the outset how well its structure and functionality will support the completion of the VAT processes. It's equally important to know the extent that technology will be used for electronic invoicing, tax engines, tax reports, and other VAT-specific processes, and to make sure that they are in line with any local VAT rules and guidelines. In case of more applications, this increases the chances of manual adjustments having to be made for consolidation or other purposes, which in turn leads to greater VAT risks because of the higher margin of errors. If employees with limited knowledge of VAT end up being responsible for manipulating and entering data, the central question is whether the data can be considered sound. Here are some questions that can help you refine the design of the VAT Shared Service Center intersection for short, medium, and long-term functionality. What kind of supervision is in place for Shared Service Center staff responsible for carrying out the relevant VAT processes? Is hard copy documentation available on how staff members should carry out VAT processes? Alternatively, is technology used to select tax codes, and is assistance provided in the form of internet tax engines? What duties and responsibilities for VAT processes are aligned to the different members of the shared service center? The business units, IT, tax, finance, or other departments. Have these duties and responsibilities been clearly defined and documented? Is everyone aware of the responsibilities in terms of monitoring, delegating duties, and establishing efficient and effective communication lines between staff members with varying responsibilities? What does the internal control structure pertaining to these processes look like? Which controls have to or can be carried out at the shared service center, and which have to be or can be carried out at local level? Upfront agreement and alignment. Underpinning all the activities of identifying, diagnosing, and designing the shared service center treatment of VAT is transparent communication and a well-defined service level agreement that everyone involved understands and supports. That must include the responsibilities both within and outside the shared service center, the division of duties and the protocols for communication, resolving and escalating issues. Likewise, the VAT workstream should be integrated with technology and finance projects. This may prove challenging as the number of initiatives, particularly those that deal with system development and technology enablers, are often not visible to the tax function. Another point that underscores the need for transparency and upfront communication. Failure to align with initiatives that can intersect with VAT can result in a VAT design that is inefficient from a process perspective and not a best fit for the business. Last words and leading practices. It is managing change by design, looking at every process and transaction from start to finish, and factoring in all the requirements and controls essential to designing and optimizing a compliant VAT process. It also means addressing the roles and responsibilities connected not only with the processes being moved to the shared service center, but also with those that are being left behind, fully and accurately capturing local knowledge about how things actually get done. Phoenix Consulting is a company led by 6 partners and a team of around 30 employees. Our main business focus is to optimize SAP from a tax, financial, and control perspective. We have offices in Amsterdam, Berlin, and Cologne. We hope you enjoyed this webcast and hope to hear from you soon.